Hi, everyone, and welcome to today's webinar. We're really excited to be here with you today. I'm joined by Jimmy Bassett, who's a senior financial advisor on our team, and we're going to talk to you about our new Arden Woods real estate strategy. And we're going to answer. Jimmy's going to ask me questions, and then we're going to save time for specific questions that you have. So feel free to ask away as we get into the webinar today. So let me just, as a refresher for those of you who attended our first webinar, and as an introduction for those of you who couldn't make it, let me just start from the beginning about what the strategy is and why we like it. So this is something that we believe is very special. This is something that we had to build ourselves. To be quite frank, I don't know of another investment that's as attractive as this one. It has very, very interesting risk return characteristics. So not only have we found that the investments that we have made have been have performed well, but we also have found that the risk of these investments is not as high as stocks. Real estate in and of itself is not as risky as stocks, and we're not planning to use any debt for this fund. So in other words, we believe that this is a less risky strategy than let's say stock investments. Not bonds, of course. Bonds are a completely different story, although we think that bonds are not going to perform as well going forward given the low interest rate environment that we're in. Real estate is a complementary strategy. Real estate can behave independently, and that's what it has done historically. It's behaved independently of other investments, and so it can be a nice complement to a portfolio. And even with a relatively small allocation to this investment strategy, we believe it could have a meaningful impact on your portfolio. So what is it? We're investing in real estate that we're purchasing through tax sales, and we have other complementary strategies to acquire the properties, such as directly from local governments. And I'm going to get into through the Q&A. I'm going to get into exactly how the strategy works and why we believe it's very attractive. So on that note, let me turn it over to Jimmy, who I know has some great questions that he wants to ask me.
Sure. Thank you, Andrew. Good afternoon, everyone who's joining us today. Kind of as you're going through, Andrew, I think, just to start off, as us in the firm have been, seeing this develop. We've known it's, the real estate fund's coming. I'm going to be talking about it soon. And now I know it's being, put out there as Arden Woods. Just, out of curiosity and to fill people in, what's the history or the thinking behind that name?
Yeah, so Arden Woods, the way that Arden Woods came about is that I was looking at properties in Delaware, and then I found an area of Delaware, Arden. My wife is from Delaware. She grew up in Wilmington, and at the same time, we were trying to identify a name for our soon-to-be born son. And we know we wanted an A name, and we came up with Arden. I said, "Hey, Arden Woods." She said, "Actually, Arden's this great place in Delaware, and her father's house was against Arden Woods, and so she had fond memories growing up of Arden Woods, and we needed an A name, and so we came up with Arden. So Arden Woods is near and dear to me, and I guess you can say has some origination in our real estate strategy."
That's sweet. That's a nice story. To go back to the strategy a little bit, you talked in general about real estate and how it can complement a portfolio. how are we looking at real estate specifically, and why do we pick this strategy? I mean, I'm thinking kind of just how it fits into, the way we typically put together portfolios.
Yeah, so I think everyone on the call, as our clients, know that we're value investors. We want to buy things that we feel are worth more than the price at which they're selling, and this real estate strategy is typical of that. We're looking to buy properties at significant discounts to the value of the property, and so we are trying to make our money at purchase. We're not as concerned about the housing market. We're not relying on the housing market to make the returns for us. Once we buy the investment, then we can begin to celebrate and say, look how cheap that we bought this for. It's worth this. It's worth X, and we bought it for Y at a significant discount. Real estate in general is a less efficient market. That means that if we go to purchase a property, we feel that we can have an advantage over other people looking to purchase the property. Now we're buying these through tax sales, and so those are the sales that we need to beat out competitors. But we believe that we can have an advantage, and which comes from the size that we're looking to invest, that we're looking to invest more than the locals who are showing up, and we can outbid them, but we're not looking to put to work hundreds of millions of dollars in this strategy, so we can buy enough that it makes. I don't think it's possible to put to work hundreds of millions in this strategy, and nor do we need to do that. So we're just in the sweet spot, in our opinion, and this has, as I mentioned, very favorable risk-reward ratio. Even the returns, and I'll go over the returns of the seed fund that we got in the seed fund so far, that we've realized and that we're projecting based on our investments. But the returns have been very attractive, and so we're buying things cheap, and we're also making improvements as another way to add value. But when we buy the investment, we can, if we wanted to, we can turn around and sell it to someone else in its current condition. But if we're going to most often also participate in the value creation process of improving the property, and in some cases building homes as well when we're buying vacant land.
No, and that sounds like a great opportunity. It certainly sounds like it kind of fits with the way that we put portfolios and look at investments. And again, structurally, the way that this sounds is definitely attractive. But you had mentioned that you had the seed fund that you'd already done some investments with. Could you give us a specific example of kind of how one of those situations would play out?
Yeah, of course. So how does this work? So let me give you an actual example, and I have a slide here. If you give me a second, I'm going to pull it up and actually share and work through a specific investment. Okay. So here's a property that we bought in the seed fund last year, and this is a good example of how the strategy works. So we bought this property at a tax sale, and there are two different options for how what could happen with this property from here. The first option is that the property gets redeemed by the owner. We bought it, and the owner, who's an investor, could redeem the property, or the owner doesn't redeem, and we get absolute control of the property. And in most cases, the vast majority of cases, we get in our experience, we get control of the property. The owner doesn't redeem. what happens here? We bought it for 130. If the owner redeems, we will get a 20% return. The owner can redeem, and we would get a 20% return on our investment. If it's 1 day, we get 20%. If it's 365 days, we get 20%. And if we don't, if the owner doesn't redeem, then we get the property. Now the property is worth, it sold a few years ago for $277,000. It's in a great part of town. We see pictures of the interior because it's an Airbnb property. The interior is in great shape. This is a very desirable property. So we would have received a property that's worth north of $280,000 for $130,000. So those are the two options as to what will happen with this property. Now we've already held this property for over a year, so the 20% actually we bought this in Georgia. The 20% property return kicks up to 30%, and so we have here an expected IRR of either 32% if we gain control of the property, or 27% if the owner redeems, and the owner has a short period to redeem, and as I mentioned, we expect that the owner will not redeem and will walk away.
That's great. No, I mean, that's nice to kind of see how that plays out kind of in real time and, really kind of concretely. Now, you mentioned before, you're talking about kind of the tax liens that come in on these types of properties that we may be buying at auction. How's the priority of that work kind of within the system?
Yeah, so the government has created the rules for this strategy. The government's created the priority of the lien that you're buying, and also the way that the penalty return works. And so we are buying a deed for the property, and this varies by state. In some states you get clear title outright. In other states, like in Georgia, you do not get clear title, but you have a very high priority lien. So you have this super lien, and you're ahead of the bank. You're ahead of, if there's a mortgage, if there's a homeowner association lien, if there's a mechanic's lien, if there's a judgment, you're ahead of them. The only other liens that you have to care about, and that we definitely look for, are other governmental liens like state liens or IRS liens, and even those you can work out. There are ways to work those out, and I won't get into how for the sake of time. But the lien priority is on your side when you're buying through tax sales in most cases, and it varies by state, and that's why we have to do research and understand all the rules of the states that we invest in, and have done that. So that's a little bit about the lien priority. Again, the government creates the rules and has created some very favorable dynamics for investors.
Okay, that's great. And I have a few more questions to ask, but I also just wanted to mention for any of our attendees on the call today, if you have some questions as well, feel free to ask them through the chat. I think we're going to have some time at the end to go over a few of them. So definitely, if you have anything, you can post it in the chat box, and we'll try and get to them as much as we can at the end. Now, Andrew, you were mentioning before, this is, there's laws that are state specific. I know we're going to a lot of different areas to kind of acquire and go to auctions and buy these. It seems like a very niche strategy, and I'm just kind of like wondering, where this idea originated for this type of investment.
Yeah, and just I should probably just add on to what the example I gave before about lien priority. You do get clear title ultimately with the property. It just you don't get it at first, and then you work to get clear title in Georgia. The way that this came about, this is you're exactly right. This is a niche strategy. I have been researching this strategy for many years now. I heard about a related strategy from a client, and it took me down a path of it sounded interesting. I started researching this strategy. I also love to travel to Savannah, Georgia. That's where I got married. That's my place to vacation. And it turns out that in Savannah, Georgia, or in Georgia in general, this is a very attractive place to invest in this type of strategy. That the penalty return is 20%, and so I would go down there, and my vacation would be to drive around, go there for a long weekend. I'd drive around, see 30 plus properties, do a ton of research, and invest money. And I have been investing in this strategy since 2016, and I saw that there was something special. I saw that this was very attractive, and I wanted to be able to offer this to clients. So what we started to work on scaling the strategy, and we started to work on expanding to additional states. Like last year for the seed fund, we bid in 5 different states. We are actually bidding at an auction yesterday and acquired 2 properties. And we hired analysts to work on this strategy, and we ultimately launched the seed fund in August of last year. We deployed that seed fund is owned half by the Alternative Value Fund and half, which is a private fund that we manage for at Altfest, and then it's owned half by Lou. And so Lou has put his own money into the strategy, and we'll be putting his money into this new real estate fund. And again, we think that it's very attractive.
Kind of along the lines, of it being attractive. I mean, it certainly sounds interesting. When it comes down to performance, how has the seed fund done so far up to this point?
Yeah, so I showed you one property in the seed fund, and I have additional properties that I could show you. So here's another property that we purchased last year, and this was a winner for us. We bought this property for $250,000. We put in $110,000 of renovation, and we have the property now under contract at $525,000, and we're expecting to close this month. So this is a 14-month hold and an expected return of 32%. So this appears to be a winner for us, and it's owned again half by the Alternative Value Fund and half by Lou. I like to kid around with Lou and Karen. So I showed Karen a picture of this property after we acquired it, and said, Karen, look what you own. You own half of this property, and there's a pool in the back. I could showed her an aerial view, and she said, "Can I go and visit the pool?" And Karen, you can't visit the pool. But it's been a winning investment for us. This is the property we just went over. This was the third property that we acquired in the seed fund. This is also in Georgia, and is an example of a property that just got redeemed. And so we put $100,000. We bought this for $100,000. The property, it doesn't look as attractive. You wouldn't know from this picture. This is actually a very high value property. It's a $390,000 valuation of this property. We bought it for $100,000. So if we would have gotten the property, if the property didn't redeem, we would have had a very high expected return. The property did redeem. This is a case of a 20% redemption return. So we got back $126,000. What I'm not showing you here is that we put in another $5,000 to pay subsequent taxes. So our return was we got back $126,000, and when you factor in some travel costs, then we had a 17% return on investment. So nothing to be ashamed about at all. 17% return for not even having to own the property or do any work on the property. But of course, the returns are highest when we acquire the property, and as I mentioned, historically most properties do not get redeemed.
Yeah, that sounds good. I mean, the returns it sounds like we're seeing so far, and a lot of these are definitely strong, definitely attractive. One question that I know it came up on my mind, and I know a few other advisors when we started hearing about this, is what's social impact? We hear this idea of we're taking over tax liens of houses from others. How does the social impact come into play with these strategies?
Yeah, so it's a great question, and this is a strategy that we feel very good about. This is a strategy that we feel aligns well with our values, and that we're doing good in the community, so that when we this is an example of a public-private partnership strategy, so that we're working very closely with local governments. We are first, when it's a tax sale that we're participating in, the money that's raised is going to pay for schools, fire departments. The local governments are raising revenue. Often we are buying blighted properties. Blighted properties are, we buy condemned properties, we buy properties that are unsafe, that are depressing values in the area. We are also buying directly from the government. So these are properties that are part of local government's revitalization plans. We're putting on affordable housing. There's a big problem in our country that I'm sure everyone's familiar with, where there's not enough affordable housing for people who are in more of a workforce category, like school teachers. I just actually sold, or I have under contract, a property that I bought that was used to have a house there. The house was in terrible shape, empty house, unsafe. The city tore it down. Some years later, I bought the lot. The lot was overgrown, full of debris, and the neighbor was complaining constantly to the maintenance department in the city. And I built a house ground up on the lot, and I sold the house. The house is under contract now to two reverends, who are working in the area, and they had to get a loan from, they got a loan from the Neighborhood Assistance Corporation of America, which focuses on providing loans to lower income borrowers and in lower income areas. And so we very much invite and welcome selling homes to people in programs that are in government supported, or programs that support home ownership, first-time home ownership for lower and moderate income individuals. So this is a strategy that we feel very good about. We have no interest in eviction, so that I want to make that very clear as well. And we prioritize vacant properties as well.
That's great to hear. No, I think that's a really good point. I know, one of the first times you were explaining the strategy to me and brought that up, that was certainly something that, made me feel, happy to be a part of kind of like this as an investment element of our firm. To get a little bit more specific onto, how this comes into play for clients, there was one question I had, and actually one of the questions that came in, I think could fit nicely here. What kind of allocation of a portfolio would you recommend? And to add on, for a client that may have like a 60-40 split through a portfolio, where would we potentially take from to do an investment like this?
Yeah, I think that's a great question. I think we are recommending a 5% allocation to this strategy. And so this strategy, for this particular fund, we're planning to raise a fund as much as every year. So if you put in we could see this growing as an investment to as much as 10% of a portfolio. So if you put in 5% into this fund, then when the next fund comes around, you can put in another 5%. This fund will still be in existence. We're not expecting a very long hold period for this fund. We actually expect this fund to be a 3-year fund with money coming back along the way. Of course, if we think it's in investors' best interest, we could extend the hold period for the fund. But we're expecting a relatively short 3-year hold. And so we think that a 5% allocation is a reasonable allocation. The money is not automatically being reinvested into this strategy. So the next future funds will be separate investments. We think you should be not tying up all of your non-retirement account money in this fund either. We think that this is a good investment to have outside of your retirement account. So in general, this investment will be not tax advantaged in a retirement account. So that's why outside of a retirement account, your taxable money is much better for this investment. And this investment will also be eligible for the QBI deduction. If you are eligible for the QBI deduction, it's a 20% tax deduction, and real estate is included. It does phase out if your income is very high. So you'll want to speak to your accountant to see if you're eligible for the 20% deduction, but we've been advised that this strategy is eligible for a 20% tax deduction. So right now we're not recommending this for your retirement account. We are investigating a couple of other structures that could make sense within a retirement account, but right now the funds, you should really consider it outside of your retirement account.
No, that's great to hear. And actually, the next question I was wanting to know about was more on the fee side, and that actually also ties in a little bit, I think, to a question that came through of what are the fees associated with this, and to that end, how do the profits translate out to the individual client investors?
Yeah, good question. So the fees that will be charged in the fund are the fees that our analysts, the analysts we hired, their salaries will be allocated to this fund, and there'll be some other administrative costs, including tax prep, including administration costs, the costs for the fund documents. So there'll be some other administrative costs, but just the cost of the analysts who are working on this strategy. And then there is a incentive fee that only applies if the fund is profitable, and of course we expect this fund to be profitable, but there's a 20% incentive fee once the fund clears a 10% hurdle. Then Altfest will get 20% of the fund's profits beyond once the return clears 10%. So the fund doesn't if the fund doesn't make money, then we don't make any money on the fund. So that's something to I think that's very important to keep in mind, that our incentives are aligned, and this is a typical structure for a real estate fund.
No, that's great. And again, I think we had a few questions come in, which I think I'll get to in just a second. But before I jump into them, I just do want to make sure it's clear, if a client is interested in signing up for this fund, what's their best next step if they want to do it or find out a little bit more and potentially look into it?
Yeah, the next step is to reach out to your primary advisor at Altfest. Let them know that you're interested in this fund. We want to keep track of everyone who wants to participate. We are expecting to raise $10 million, and once we get beyond $10 million, then we're going to just do it on a we're going to look at the supply that we get and do it on a we're going to invest that money just if we can actually if we find that supply will go beyond 10 million. So please express your interest early so that we can put you down and that you can participate and we don't go beyond before we go beyond 10 million. And your Altfest advisor will give you some sense for where the money will come from. If you have money outside of your portfolio that you would like to contribute, of course, that could be a good source of funds. If you want the money to come from within the Altfest portfolio, then your Altfest advisor will work with you on freeing up or sourcing where the funds will come from, what makes sense to sell within the portfolio to invest in this fund.
Okay. No, great. And again, just a reminder for anyone that may have joined recently, if you have any questions you'd like to ask, we're going to try and get to a few now. Let's see. So I think we touched on a few, but there was a good question that came in. How do you learn about the details of the given markets where we're investing and who's watching for specific opportunities to arise?
Yeah, so we have to get comfortable with the markets in which we're investing. We have to, before we invest, we have to understand. We look at a number of things. We want to look at population growth. We want to understand what the employment situation is, who the major employers are. We want to understand the supply on the market. We want to look at the specific housing market and see what's supply like, how long are homes staying on the market, what type, and we want to look at that not just overall, but we want to understand by price point. We want to make sure that the housing market is healthy. And so the way that we do that is we do research, and then we speak to brokers on the ground and get feedback about the specific about the market as far as which property, how long are properties staying on the market, by price point, by type of property, and we have to get very comfortable. We do our own research in terms of comps, sales, and so when we're looking at specific properties to buy and we're evaluating them, we're looking at what other properties like those have sold for. We speak to brokers and we get feedback on the specific property as well.
That's great. And I think kind of following on that a little bit was a question that came in, at least part of one that, you a member of kind of overseeing this strategy, and our investment analysts are looking. Similarly, when you talked about, a property that we buy and have to rehab, how do we go over the process of like overseeing construction that's needed and items like that? Yeah,
so the great thing about doing this for a number of years now, one of the lawyers that we work with, he compared this to a college education. He said, well, you pay for college, you go for 4 years, and when you go over to NYU, you'll pay this amount of money. So we've been researching this for at least 7 years, and so I don't know what the equivalent is. We're beyond college. We're into definitely into masters. The great thing about doing this for so long now is that you learn from doing, and when we learn, we take all of our learnings and put it into a detailed process, whether it's about acquisition, whether it's about construction management, whether it's about being effective at auctions. I mean, and there's a whole art there as well. When it comes to construction management, we really want to make sure that we're not getting a headache. We're not getting someone who's going to slow things down. Now, we buy cheap enough so that if it takes longer or if it costs more, we still believe that we're going to make out fine. But we're trying to find contractors who we source contractors from that were referred to. We check references. We go and actually do an examination of them individually. We look to see what complaints they've had. We look to see if there's any lawsuit history. I mean, we're doing a very detailed investigation of the person that we're working with, and that has worked out well for us. So, in early on, we had some people who are more difficult to work with. Now we're working with people who are moving fast, and I think that a lot of that has to do with not trying to go with the cheapest person, and doing our due diligence on the people that we work with, and our process, learning along the way has been invaluable.
That's great to hear. We have a little bit of time left. I'm going to try and combine a couple questions in these last few that I'm going to be asking. And some of that kind of goes money coming in and then money coming out. So first of all, just wondering about how kind of the capital calls might work that are addressing this. Is all of the commitment going to have to go in at once? And then on the back end coming out, how are capital gains and taxes handled when there are payments made out to investors?
Yeah, so those are great questions, Jimmy. We're going to have capital calls along the way. So we want to raise money when close to when we need to deploy that money. So we're expecting capital calls to happen, a capital call to happen early on in the fund, and then as we go and acquire more properties, then we'll be making additional capital calls. And so we'll help you administratively with that to complete the paperwork to actually to execute the capital call. As far as taxes go and reporting, we will issue a K1. The fund will issue a K1, and you should expect to be on extension. We've been told that by our tax advisors that the K1 will be ready shortly before April 15th. However, to be conservative, you should expect to be on extension because we can't control for if a service provider doesn't execute, they get very busy preparing K1s for many people before the filing deadline, and if the service provider can't execute, we're not going to be able to control that. So you should expect to be on extension, and you'll receive a K1, and that's how the tax side of it will work.
Great, thanks, Andrew. I think this is our last question for now. You mentioned some of the properties have been in Georgia that you've invested in. What are some other states where you've currently bought properties or are looking to purchase?
Yeah, so we've been buying properties in the Southeast, Northeast, and we are also planning to buy properties in the Midwest, and have been spending a lot of time analyzing properties in the Midwest as well. So we're looking at places that, again, have a healthy housing market, healthy dynamic, and where we believe that we can be effective executing our strategy, that this strategy works well in the market, that we can buy properties at the prices that we want to be able to buy them at significant discounts to the value, and all of that is part of as part of the process as to where we invest, and that's led us to Southeast, Northeast, and Midwest. A difference. We're gonna, and to be very specific, we're planning to invest in 8 to 10 states.
Okay, that's great. I think that's all the questions we've had come in so far. If there's any other questions that any attendees have today, or please, as Andrew said before, reach out to your advisor. You can send those in. We're happy to either answer them directly, or get the information from Andrew and the team to get a good response out to you.
Thanks, Jimmy, and thanks to everyone who participated today. Of course, as Jimmy mentioned, feel free to follow up with any questions you have, and be happy to answer them.
Great.
Okay, take care, everyone.